3, 2, 1.
All
Welcome
right.
to the show.
Another big week. Big Nvidia. If you're in Nvidia, it was a huge week for you.
Yeah,
Huge.
a lot of talk. A lot of talk about Nvidia.
Huge Thursday. We're gonna take a look at Nvidia chart.
I was a little
Among
busy on
other
Thursday.
things.
I wasn't watching the market.
Dude. Yeah, I wasn't watching Nvidia. I mean, I was, but it's a crazy market out there right now. It's just.
Yeah, we were looking at a bunch of things yesterday afternoon when I finally got to the office, and took a big exam yesterday, so my head was ready to explode. But we started looking at a lot of different things, and as we always do, and it was, basically we came to the conclusion that, it's like so many things that have held historically true are just not happening anymore.
Right.
And so all of these, all of the folks, whether they're, just if you want to call them retail investors, just everyday people that think they know a lot about the market and how things work, most of that knowledge has come from hearing this kind of historical narrative, right? This is what always happens. This happens and this happens. And if you are stuck in that narrative and you're not willing to actually look and see what's happening, you're going to get fried, because things are not, bonds are not working the way they're supposed to, right? The market is not necessarily doing what it's supposed to.
Right.
And because of all that, you have to, I think that, of course I'm biased, but our approach has always been, the market doesn't care what you do or what you think or what you want or any of that. It's just going to do what it's going to do. And so all you can really do is respond to the market.
Yes.
That's it. And so it's nice to know why. It's nice to be able to forecast. It's nice to do all that stuff. But at the end of the day, you have to make your decisions on what's actually happening.
You sound like J.C. Perez.
Well, you've drilled this into me for years now, man. I'm like I'm gonna be a talking head here.
That first part was funny because that's exactly what he's been saying for the past 3 weeks.
Yeah. Well, so I was just talking about, if you guys have heard me mention, I'm kind of Jerry's going through the Chartered Market Technician program, which is what is kind of like the epitome of the technical analyst's kind of credentials. And I'm doing the exact opposite, which is the Chartered Financial Analyst, which is more fundamentals. There's a lot of technical into a lot of quantitative analysis and, all that stuff. But anyway, it doesn't matter which side you come from. It's the same mantra if you're truly paying attention, which is like, hey, you can only respond to what the market does. All of the analysis in the world, it's not that you would just ignore it, but at the end of the day, as soon as it doesn't hold true, you put it to the side.
You have to flip to the next thing.
And you go again. Yeah, there's no other way. And I think a lot of people, because they've been hearing these same narratives, these same kind of storylines about what the stock market does, they've been hearing it for years. I mean, I did. I grew up, my grandparents telling me, I know you guys talked about the market way more in your family, but, in mine, it was, the only thing you ever heard was really like this whole idea of, be in the stock market when it's going up, be in the bonds when it's going down, and that's about the best you can do. And that might have held true for a number of decades, but it's not our reality now.
That's why everybody is getting crushed. It's not just retail investors that look at it like they've learned things along the way.
We know that institutional
experts,
investors are doing it too. Yeah.
I mean, gold is supposed to be through the roof right now. When everybody knows, right? It's common knowledge that when inflation goes up, gold goes up because gold is a hedge against inflation.
Yeah,
it's not happening.
Yeah, we were looking at one of the things specifically we were looking at yesterday was a pretty interesting article an analyst wrote pre-2020.
Yep.
So it was written in early 2020 or late 2019, and so with that as your endpoint, like you don't know what's getting ready to happen.
Right.
All the things that the person said kind of held true.
Yep.
And then it all went completely to crap since then. And so the model that he was kind of proposing sounds great, but it just doesn't hold true anymore. And it has to do with, gold in particular is one of those safe havens. And it's just, wait a minute, that doesn't work anymore.
Yeah, gold and bonds. And COVID changed everything. And,
it did.
Does it change everything forever? I don't know. Probably not.
No, I think because of that, as we know, the most things work in a cycle. And so we're in this cycle, and I would like to think that it's going to self-regulate at some point, and it kind of cycles back into whatever normal is.
Yeah, right.
Or maybe it doesn't. Maybe this is. I used to hate when people kept saying this is the new normal. This is the new normal. But maybe it is. I don't know. I mean, it would suck because, if you don't have those correlations, if that doesn't ever get back to normal, then you really can't manage the market it's not in a manageable way. Like you're going to be guessing at a lot of things because you have to have this kind of rhythm.
Yeah.
You have to have patterns, and humans do it. So that's why I kind of got faith in the cycle. Is humans are humans, and we'll get back to kind of normal distribution, and we'll be like, okay, let's stop, printing money and inject it in the economy and lowering the rates below 0% and all this crazy stuff that we've done in the past few years.
Yeah, I mean, we've talked about it quite a bit.
We're doing a whole podcast before you start the podcast, man.
The rates peaked in 1982 at almost 20%, and they've gone down for 40 years until 2020, and they started going up, and they went up in a hurry. And when rates go up, stocks are supposed to go down. And obviously that didn't happen, right? There's the oldest adage probably is don't fight the Fed.
Nobody told everybody else.
Yeah, apparently not. When rates are going up, you're not supposed to fight the Fed.
Right.
Stocks are going down, and it's not what's been happening. So yeah, all of the conventional wisdom.
Is it those darn millennials? Are they the ones doing it? Everybody blames the millennials.
They're the
ones in
YOLO,
charge.
the YOLOing crypto and stuff, right?
All right, what do you got, man?
All right. So this is a pretty good one. I got an article to show you guys about TSP matching. It's kind of quick, but it's probably the most important thing we're going to talk about today, to be honest. The dollar, critically important. Haven't talked about that in a while. It's acting like it shouldn't. Surprise, surprise. New highs, new lows. We talked about last week. We're going to do a little update on that. TLT is a bonus chart and the C-Fund chart. Before we get to all that, Nvidia. So I don't want to belabor Nvidia. I just want to use it as an example. This is a regular price chart. Okay, so when I say regular, it just means on the side here, the dollar values are going up in even amounts, right? 200, 240, 280. They're going up every $40 increments all the way up. So it's a regular price chart. And it looks like this whole area, nothing happened in Nvidia. It was flat, right? And then you got a 1, 2, 3, 4, and we're in this monster 5 wave. So at some point, Nvidia is going to come back down to earth. And somewhere in here is probably what you're talking about. So can it keep going? Sure. But at some point, it's going to come back down to a level that's probably going to be something like this. I'm going to do a kind of a comparison with the NASDAQ on the newsletter this weekend, because if ever anybody that remembers back that far, this chart isn't too unlike what the NASDAQ looked like in 1999 and 2000. And then after that, the NASDAQ dropped 87% of its value. 87 or 78, I can't remember. It's somewhere, let's say 80%. Something like 80% of its value. So hopefully that doesn't happen this time. But anyway, this is what a regular chart of it looks like, okay? This is the same chart. It's the exact same chart, but it's logarithmic. So the interesting thing that I kind of wanted to point out, here's the beginning, and here's 2016. This move, logarithmic means the distance, the distance is the same. The percent price move is the same on each distance. So if you went from $4 to, I wanted to say 8, but it's not there. So say 8. That's a 100% move. So every time this goes up this distance in the chart, it's a 100% move. So this move back here, right, was, not as big as this move, but it was huge. Right? On a percentage basis, it was huge. Back here, you couldn't even see it. Okay, so all I'm saying is if you're looking at long-term charts, logarithmic charts are the way to go. I pretty much have mine on log scale all the time. But the trend lines change. So if you're connecting trend lines and you do it, because now you can do it in logarithmic. You can wait for Nvidia to come back down to a trend line, buy it there. Maybe it keeps going up. Great. You can't see anything like that on a regular chart.
Not when it has that look to it, for sure.
Yeah, it just you can't do it. You can't draw it. So the logarithmic scale is much better to use. Yeah. So anyway, this little move down, back to here, that was 470, right? So just that little move back down is 470. That's what I was talking about. We come back down to something like that, and on a logarithmic basis, it's barely even a blip. Okay. TSP matching. So this is from a Federal News Network article I saw this week. So the number of TSP participants receiving a full match reaches record high. That is really good to see. So it was one of the retirement board's kind of strategic goals was to maximize people contributing that 5%. So currently there's about 87% of feds in FERS and about 85% active duty in the blended retirement system, putting at least 5% of their biweekly paychecks into the TSP.
That's pretty good.
That is good. I feel for those 15% that are not, because I mean, we were just talking about it. If you're making,
well, I wonder if
grand,
they. I didn't hear it because we started talking about this before we got on air, and didn't think in consideration if where that 15% is. Are those people that are towards the end of their career, or are they retired and still in the TSP? Because that could affect it. If they're counting those folks that obviously wouldn't be in, putting in anymore.
I mean,
I hope they would take those
not.
out. Yeah, I hope they would take those out. But as Jerry was getting ready to say, I mean, if you make an average of $100,000 a year, I have people ask me all, whenever I get in a discussion about TSP and they want to start talking about all this fancy stuff that we do, I'm like, hey, let's start with ground zero. Are you putting any in there?
Yeah.
And they're like, oh yeah, I contribute. I'm okay, dude, you contribute at least to the max, to the matching max. And then there's always a little stutter, or whatever. And I'm like, look, you're leaving money on the table. It's free money. If you give 5% of your income, they're going to give you 5%. That means you're going to get a 100% return on your money every year. Yep. So make the math easy. You were going to say 100,000.
Yeah. I mean, so you're getting you're contributing 5,000 a year, and it's before taxes. You're not getting taxed on that if you're in a regular TSP, right? Not Roth.
Yeah.
If you're in Roth, you are getting taxed on it. But if let's just say your traditional TSP, you're contributing 5,000 a year. The government's contributing 5,000 a year. You just made 100% on your money.
Yeah, you got $10,000 instead of $5,000, and you over 26 pay periods, you're looking at a little less than $200 a paycheck, basically.
That you would contribute.
Contribute. Now, first, I get it. I remember times in my life where $200 a month or $200 a pay period was a big deal, but just put it in perspective of what the difference is, long term for your retirement. They're giving you $200 for every $200 you give them, and so. I just think the incentive is there to do matching. It's you have to do that to the very. If that's all you do, with compounding and all the time, and being in the right place in the market, that's again you're doubling your money every time you give it to them. Right.
I mean, before you even start trying to figure out which funds you want to be in, what the market's doing, and all that,
maximize your matching.
Yeah, 100%. But that's good. 85%.
I wish they'd match 100%.
Yeah, 100% would be nice. Okay. The dollar. So we've showed this chart quite a bit. As you guys can, we're going to see it on the next chart. But the idea is when the dollar. So in 2022, the dollar's going up, stocks are going down. Right. The dollar peaks in October 2022. That's the same time that we had a bottom in stocks. So the dollar is falling and stocks are going up, right? So there's a really good inverse correlation between the dollar and stocks. And so where we are right now on this Fibonacci retracement that I did, right? So we had a peak in the dollar back here in September, October of last year. That was the low in the market last year. The dollar went down, stocks went up into the beginning of the year. Okay. Since then, the dollar has been going up. What's supposed to happen when the dollar goes up? Stocks are supposed to go down.
Ding, 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 ding.
Right? It hasn't been happening. Okay. That's an aberration. But the dollar recovered to that 61.8 retracement level, and then maybe it's turning back over and going down. Right? It's not really confirmed yet, but it looks like it wants to go lower. If the dollar goes lower, that is a really good tailwind for stocks, meaning stocks should go higher, because when the dollar goes down, stocks go up. And the setup right now is for the dollar to go lower. So that's really bullish if you're looking at stocks. So this is the same chart kind of zoomed in a little bit. So here's 2022. The dollar's going up, stocks are going down. Dollar peaks, stocks bottom. Dollar comes down, stocks go up, right? They're both going kind of sideways for a little bit. Dollar down, stocks up. Dollar up, stocks down. Dollar down, stocks up, until we get to here, beginning of the year, dollar up and stocks up. Okay, it's really strange. Has it ever happened before? Rarely, and only for a short amount of time. And this is the only other time in the chart I could find it. So you get a really little bit of time there where the dollar's going up and stocks are also going up. And then when the dollar rolled over there, it really pushed stocks higher. So if the dollar comes down here, stocks should continue to go up. Okay. Hopefully that makes sense. This is a big one. If the dollar goes down, stocks are going higher. It would be very unusual to have the dollar come down and stocks come down. That would be, as unusual as this is right here. So we'll see. Okay. New highs, new lows. So we this is the chart we put out last week. You got price going up. This is the S&P 500, right? You got price going higher. As price goes higher, the new highs list peaked in December. So each high is lower, right? So you have less companies making new highs, even as the price of the index keeps going up. So we were saying that that's kind of unsustainable, right? It's an indicator that the market should be getting ready to roll over. So what happens this week? This was it was Thursday, right? Nvidia exploded to the upside. Stocks really went higher. And what happened, I zoomed in this one that I didn't do last week, but it's kind of a zoom in on like a few days. So this was the peak in December. This was the decline we were talking about. But then a whole bunch of companies on Thursday powered higher. It wasn't just Nvidia. So now we have a bunch more companies that broke the trend line, right? Broke that down trend line. So it basically invalidates this. So that indicator that, hey, the market's getting ready to roll over got invalidated on that day. Right? And you can really see it when it zooms in here. This would have been the downtrend line, and it really invalidated it on that day. The other thing is this. If the market's going to roll over, we would expect fewer companies, we would continue to get lower highs. The other one is you want to see more lows. So we had less companies making new lows. Okay, so this is really unusual, right? You have less companies making new highs and less companies making new lows. So there's a lot of strange things going on in the market. And it tends to happen at tops. And whether the top is imminent or it's being created, we are in the middle of some kind of crazy blow-off. And the timing of it is going to be very, very difficult. All we can do is respond. Okay, TLT. It's going to be a big one when the top does come. So we talked about TLT quite a bit. It's the long-term 20-plus year treasury bond. Okay. So if you started investing in the TLT back here in 2002, anything that you made all the way along was wiped out from late 2020 until it bottomed in October of last year. So from 2002 to 2023 was at 20 years. Everything that you made in 20 years, if you were in TLT, buy and hold, was wiped out. It's a historic drop in bonds, right? And it came down in this 1, 2, 3, 4, 5 wave that we've been talking about for a while. The question is right now, if this is the bottom of wave 5, is this going to be a 1, 2, 3? If this is the bottom of a wave 5, it should be a 1, a bigger, longer term 1. You would have an A, B, C, and then bonds would continue lower again, which is absolutely possible because we're only going back here to 2020 to 2002. But like we said, yield was peaked in 1982. So if TLT had existed back then, price would have been way, way lower. So even though on this chart it looks like it can't get any lower than here, it can go much lower because it had been rising for 40 years. So the reason TLT is important for us, and you can do it in the mutual fund window, in VLGSX is the ticker symbol in the mutual fund window. The orange line is the S&P 500. Okay. So when TLT is a big flight to safety. So when stocks really collapse, investors go to long-term treasury bonds. And so the boxed in areas isn't just when the TLT moves higher, it's when it really spikes. So in 2008, having eraser problems. All right. In 2008, the market had been coming down, but in 2008, when Lehman Brothers failed, the market really went down, and then that was the flight to safety with TLT, right? We had the same thing in it wasn't a huge decline in stocks, but we had a big spike in TLT. There's a lot of fear in the market then. And the same thing in 2012, huge spike. And then COVID, right? Everything went down in COVID, but TLT exploded to the upside. Okay, so if we get some kind of big market crash, stock market crash, and the market declines, TLT is so far undervalued right now. I mean, this has been a historic move to the downside. So TLT can spike like crazy right here. So you definitely want to have it on your radar. VLGSX. So if the Fed starts lowering rates, not because they feel like it, but because the market's falling apart, VLGSX is going to go through the roof. Okay. And if we zoomed it in a little bit, this is kind of the idea. So this was the bottom of the 5 wave. Let's call it a 1. So that first move higher that finished at the end of 2023, that's the A. And if we're having an ABC correction, we should be almost done with that correction. So sometime around March, wouldn't be surprising to see the market roll over and TLT take off and do, come back up to the prior 4 wave, which somewhere around 112. It could go much higher, but that would be kind of the minimum, because then you have a long-term A, B, C for 2, and then we start falling again. Hopefully that makes some kind of sense, just basically to have it on your radar. So anywhere down here at around 91, if you're looking again as a TLT, that's probably a good target. Okay. C-Fund chart. So I just wanted to do this for the C-Fund weekly. So each tick here on the chart is 1 week of price movement. And we have the 20-week moving average line in blue and the MACD oscillator down here. So we're talking all the time. You don't have to use a whole lot of indicators. And I just wanted to kind of go through what, if you are only looking at price, the 20-week moving average line and the MACD, right? If that's all you looked at and you only looked at it on a weekly basis, when price gets below, closes for the week below that 20-week moving average line, and MACD turns red, right? That would be your sell trigger. So you took a pretty big hit that first week of COVID, but you would have avoided the whole down move, right? Then on the upside, price gets back above that 20-week moving average line. MACD turns positive, and it stayed there, right, for a long time. This was a fake out, right? It closed below for 1 week, closed below that 20-week moving average line, and MACD turned negative. The very next week, it turned back around. So that would have been a head fake. But aside from that one head fake, you would have been in all the way until that first week down in 2022. Okay. You would have been out for the majority of that move down. Another bit of a head fake here, right? But then you're back in right as the market is getting ready to take off there in November of 2022. So you're getting the majority. If you only used on a weekly basis the 20-week moving average line and the MACD oscillator, you got the majority of the moves in the past couple of years, and you were out of the market during the majority of the downfalls. So it doesn't have to be all complicated. If you just use those two indicators, that's a pretty good way to do it. Okay. And of course, for our subscribers, we do day-to-day kind of market analysis. And so if you guys are interested in that kind of thing, definitely hit us up at growmytsp.com.
If you're into that kind of thing.
If you're into that kind of thing. Yeah.
Yeah, what Jerry just showed you, I mean, if you guys, if you're new to the show or maybe you haven't heard us say it in a while, we tend to go, we like to talk about a lot of different things because some people do have a lot of experience in technical analysis, especially if they've been watching us or following us for a few years. But if you're brand new, you don't have to get overwhelmed with this stuff. It can be really simple. And as Jerry pointed out in that chart, the one thing I did want to point out, you want to go back for a second? So you see where the market at times tends to go sideways, right? We were talking about this before the show. There's only so much you can do, right? If the market's not cooperating, if it's not going down or up, you can't stress over it because you can't change it. So when you get caught in those situations, you're going to find yourself getting in and out, what Jerry called a head fake. It happens to us. There's nothing you can do about it. What you can try to do is take advantage of the long-term trends. Yep. That is the way to approach this. If you obsess over it daily and you're looking at it, we look at it daily because it's our job. You guys have jobs, and this isn't it, right? You don't need to be obsessed with how the market ended yesterday. Look at it on a weekly basis. Make your decisions over the weekend and rock on. Yeah. It doesn't have to be that hard. And you do this for an entire career, you are going to fare way better than most of your colleagues. Yeah.
Well, a really good way to look at it, well, a really bad way to look at it is to say, yesterday I had 100,000 in my account. Today I have 90,000. I lost 10%. But you had gotten in when you had, 60,000 and it went up to 100,000. So you
right.
say, no, I gained 40% or whatever.
Yep.
You have to if your comparison is always the last all-time high, you drive yourself nuts.
We did a video, and I think it's on our website. I think on the performance, putting performance in perspective. Yep. Or it's all about perspective. There's a blog post, I think they call it that. Check those out on our site. It gives you a lot of insight into kind of what we're talking about. Yeah, of course we pay attention day to day, and I know it's hard not to for other people, but at the end of the day, you got to put all this in perspective. And these little dips and ups and downs, and particularly if the market's going sideways like this, experts can't play the market then. No. You certainly can't, even if you're an expert. And if you're relatively new to this, you're not going to be able to do it either.
And
so.
you get 2 trades a month.
Yeah.
More or less.
If you guys have any questions about all this, you can hit us up wherever you find this video. Put it in the comments section, and if you don't have a comment section, you can always shoot us an email at growmytsp at support@growmytsp.com. Hope you guys have a great week, and we are
Out of here.
Out of here.